Cryptocurrency, stocks, real estate, or gold. I'm sure you've heard about these before. In this video, I'm going to explain these 4 types of investments in a super simple and practical way. We'll look at what each one really is, how it works, the risks involved, the potential rewards, and most importantly, who they're actually meant for. So please give me 16 minutes and I'll give you the knowledge most people take years to figure out. But first of all, I'd like to make clear that this is not any kind of financial advice. All right, before diving into every kind of investment, let's first understand what an investment actually is. Imagine planting a seed. You don't expect fruit tomorrow, you give it time, sunlight, and care, hoping it grows into a tree that gives you more later. That's exactly what investing is. You give up spending your money today in the hope that it will grow in the future. But here's the catch. Every investment carries some kind of risk. The more potential reward you're chasing, the more uncertainty you'll have to accept. Some investments are slow and steady, others are fast and dangerous. The goal isn't to avoid risk completely, that's impossible. The goal is to understand it and to choose the type of investment that matches your comfort level and your goals. Now that you have a clear idea of what investing really means, let's take a closer look at the different kinds, starting with one of the most talked about in recent years, cryptocurrency. You've most likely heard about Bitcoin, Ethereum, or maybe Solana. These names have become extremely popular over the last few years, but what exactly are they? In simple terms, cryptocurrency is digital money. It doesn't exist as paper bills or metal coins. It exists purely online, powered by something called blockchain technology. A blockchain is a public digital record that stores every transaction ever made. Once a transaction is written there, it can't be changed or deleted. It's like a shared online ledger that everyone can see, but no one can secretly modify. The first cryptocurrency, Bitcoin, was created in 2009 by someone using the name Satoshi Nakamoto. The idea behind it was to build a completely independent financial system. No banks, no governments, and no middlemen. People could send money directly to each other anywhere in the world, without waiting days for a bank transfer or paying high fees. Since then, thousands of other cryptocurrencies have been created. Some are designed to be digital currencies like Bitcoin or Litecoin. Others, like Ethereum, are platforms that allow developers to build decentralized apps, smart contracts, or even digital art. But not all cryptocurrencies are the same. Some have strong technology and real-world use cases. Others are purely speculative, created only to make quick profits or to follow social media trends. Some coins grow fast and attract millions of investors, only to crash just as quickly and disappear. The main reason people invest in crypto is the potential for high returns. In 2010, one Bitcoin was worth less than a cent. 11 years later, it reached over $60,000. Those kinds of stories made crypto extremely attractive to new investors hoping to get rich quickly. But the same thing that makes crypto exciting also makes it dangerous. It's very volatile. Prices can rise or fall by 20% in a single day. There's no closing bell or weekend break. Crypto trades 24 hours a day, 7 days a week. That means prices are constantly changing based on news, emotions, and even single tweets. The crypto market is still young and largely unregulated. Because of that, manipulation happens often. A few large investors, called whales, can buy or sell massive amounts of coins and move the market instantly. And since anyone can launch a new token, scams and pump and dump schemes are common. Security is another major issue. If you keep your coins on an exchange and that exchange gets hacked, your funds could be gone forever. If you store them yourself and lose your password or private key, there's no recovery option. In crypto, you are your own bank, and that means you're also responsible for your own security. Regulation is slowly catching up. Some countries, like El Salvador, have made Bitcoin legal tender. Others, like China, have banned cryptocurrency trading completely. Most governments are trying to find a middle ground, creating rules to prevent fraud while still allowing innovation. Cryptocurrency is exciting, but it's not stable. It's often compared to the early days of the internet, full of potential, but also full of uncertainty. Prices move fast, technology changes constantly, and no one truly knows where it will be 10 years from now. Investing in crypto means accepting that risk. It's for people who believe in new technology, who can handle big ups and downs, and who understand that huge rewards often come with huge uncertainty. Now let's move to something much older, more traditional, and far more stable: stocks. When you buy a stock, you're buying a tiny piece of a company. That company could be Apple, Microsoft, or even a small business you've never heard of. If the company grows, becomes more profitable, and its value increases, then the value of your stock rises as well. If it struggles or loses money, your stock can go down in price. This concept is simple but powerful. By owning stocks, you're not just watching companies from the outside, you're actually a part owner. That means you share in both the success and the risk. Stocks have been one of the most popular ways to build wealth for over a century. They allow ordinary people to invest in the growth of the global economy. Over long periods of time, the stock market has consistently grown faster than inflation and most other types of investments. But like any investment, stocks are not without risk. Prices move every single day, often for reasons that don't make much sense. A company can release great news and the stock still drops because investors expected even more. Other times, prices rise just because of hype or excitement. A stock's value is influenced by a lot of factors: company earnings, interest rates, investor confidence, and even global politics. That's why short-term investing in stocks can feel like a guessing game. Prices can swing wildly in a matter of hours. However, over the long run, stocks tend to reflect real value. When companies grow, innovate, and generate profit, their stock prices usually follow. That's why many long-term investors say, time in the market beats timing the market. There are also different kinds of stocks. Growth stocks are companies that focus on expanding fast, like tech companies building new products and services. They usually reinvest profits instead of paying dividends. On the other hand, dividend stocks belong to more established companies that share part of their earnings with shareholders. These are often seen as more stable, especially during market downturns. Investors can buy individual stocks, but that takes a lot of research and time. You have to study financial reports, track performance, and understand the company's future potential. That's why many people choose to invest through funds or ETFs, which bundle together many stocks in one single investment. It spreads the risk and saves time. One of the main reasons people invest in stocks is accessibility. Today, anyone with a smartphone can buy shares with just a few taps. You can invest with as little as a few dollars through fractional shares, meaning you don't need thousands to own part of a company like Apple or Tesla. Another advantage is liquidity. Stocks can be bought and sold instantly during market hours. That makes them far more flexible than real estate or long-term savings accounts. But there are also downsides. Stocks are emotional. When markets fall, many investors panic and sell at the worst possible time. When prices rise, people often buy too late. Controlling emotions is one of the hardest parts of being a stock investor. History shows that the market goes through periods of boom, followed by corrections or crashes. But after every crash, markets have always recovered and reached new highs. That's why patience and consistency are key. Stocks are ideal for people who want to grow their wealth over time and can handle moderate risk. They require discipline, but they reward long-term thinking. Unlike cryptocurrency, which can change dramatically overnight, the stock market is guided by real businesses, real profits, and human productivity. That's what makes it one of the most reliable tools for building wealth in the modern world. Now let's move to one of the oldest and most trusted types of investments: real estate. Unlike crypto or stocks, real estate is tangible. You can see it, touch it, and live in it. It's the land beneath your feet, the apartment you rent, or the house you dream of owning. And because land is limited, people have valued it for thousands of years. When you invest in real estate, you're putting your money into physical property with the goal of making a return. There are two main ways to earn money from it. First, rental income. You can rent your property to others and collect payments every month. Second, appreciation. As time passes, the property's value can increase, allowing you to sell it later for more than you paid. For many investors, real estate feels safer than other options. Prices don't usually swing wildly from day to day like stocks or crypto. Real estate markets move more slowly and are influenced by long-term factors such as location, population growth, and interest rates. However, that stability comes with challenges. Getting started often requires a large amount of money. You need a down payment, you might need a mortgage, and you'll have to pay for maintenance, taxes, and insurance. Property also takes time and effort to manage tenants, repairs, paperwork, and sometimes legal issues. Real estate is also considered a low liquidity investment. If you need cash quickly, you can't just sell your house instantly. It might take weeks or months to find a buyer and complete the process. But one of the strongest advantages of real estate is something called leverage. Leverage means using borrowed money to increase the size of your investment. When you buy a property with a mortgage, you're using the bank's money to help you invest. If the value of your property goes up, your profit is multiplied because you only used part of your own cash to buy it. Of course, leverage also increases risk. If property values fall, or if you can't pay the mortgage, the losses can multiply just as fast. That's why responsible financing and realistic expectations are crucial. Real estate also gives investors something very few other assets can: utility. You can live in it, rent it out, or even use it for your business. It's not just an abstract number on a screen. There are different ways to invest in property. Some people buy homes and rent them out long term. Others flip houses, buying, renovating, and selling for profit. Then there are REITs, or real estate investment trusts, which let you invest in real estate without buying property yourself. It collects money from many investors and uses it to buy large-scale properties like shopping centers, office buildings, or apartments. In return, investors receive a share of the profits. In recent years, real estate has also become more digital. Online platforms now allow people to buy shares of property, making it easier for smaller investors to enter the market. Historically, real estate has shown steady growth. While it's not as explosive as crypto or as fast-moving as stocks, it tends to hold its value well during inflation and economic uncertainty. That's why many wealthy individuals use real estate as the foundation of their portfolios. It's especially appealing to people who want long-term stability and passive income rather than quick gains. Property can act like a safety anchor in a diverse portfolio, something solid and predictable when markets become volatile. Real estate isn't for everyone. It requires patience, capital, and responsibility. But for those willing to put in the work or think long-term, it can be one of the most rewarding and dependable investments available. Finally, let's talk about one of the oldest and most trusted investments of all time: gold. Long before stock markets existed, before banks, and long before anyone had even heard of cryptocurrency, people used gold to store and trade value. It has been considered precious for thousands of years because it's rare, durable, and universally recognized. No matter where you go in the world, gold means wealth. Gold doesn't represent a company or a government. It's not a promise or a contract. It's a physical metal that holds its value because people trust it will always be valuable. You can hold it in your hand, and that alone gives many investors a sense of security. So, how does investing in gold actually work? There are a few different ways. The most traditional one is physical gold, buying gold bars, coins, or jewelry. You can store it at home or in a vault, but that also comes with costs like storage and insurance. Another way is paper gold, meaning financial products that track the price of gold without you having to own the metal itself. These include exchange-traded funds and futures contracts, which are popular because they're easy to buy and sell through regular brokerage accounts. Gold has a very specific role in investing. It's not about fast growth, it's about protection. When inflation rises, currencies lose value. When stock markets crash, or when global tensions increase, investors often rush to buy gold. That's why it's often called a safe haven asset. It tends to hold its value or even rise when everything else is falling. But gold also has its downsides. It doesn't produce income like a rental property, and it doesn't pay dividends like a stock. It just sits there. Its price moves mainly because of market sentiment, global demand, and the strength of the US dollar. When the economy is strong and people are confident, gold prices often fall. When fear rises, gold shines again. Gold can also be influenced by central banks. Many countries keep part of their national reserves in gold, and when they buy or sell large amounts, it can move the price significantly. Over the long term, gold has preserved wealth, but it hasn't necessarily grown it. If you had invested the same amount of money in gold and in the stock market decades ago, the stock investment would likely have grown much more. But in times of crisis, wars, inflation, or recessions, gold has consistently protected purchasing power. That's why most financial experts don't recommend putting all your money into gold, but rather keeping a small percentage, maybe 5 to 10%, as insurance against uncertainty. You can think of gold as your financial shield. It doesn't make you rich, but it can protect what you already have. When the world feels unstable, gold offers a sense of calm and balance. It's for people who value safety over speed, those who want something solid and proven through thousands of years of human history. Now that you've got a clear idea of how each type of investment works, let's compare them all. Cryptocurrency, stocks, real estate, and gold are all ways to grow or protect your money, but they behave very differently depending on your goals, your risk tolerance, and how long you're willing to wait. Cryptocurrency is fast, global, and extremely volatile. It offers the chance for huge returns, but it can also lose value overnight. The market never closes, prices move constantly, and emotions often drive decisions more than logic. It's for people who understand technology, can handle sharp ups and downs, and don't panic easily. Stocks, on the other hand, represent ownership in real companies. They go up and down with the economy, but have historically been one of the best long-term ways to build wealth. Stocks reward patience and consistency. For most investors, they're the foundation of a strong portfolio, something that can grow steadily over many years. Real estate is slower and more stable. It takes more money to get started, but it gives you something physical like a house, land, or building that you can see, use, or rent out. It provides cash flow, potential growth, and a feeling of security. It's ideal for people who prefer something solid and predictable rather than digital or fast-moving. Gold is different from all the others. It's not about growth, it's about safety. When inflation rises, when markets crash, or when the world feels uncertain, people turn to gold. It doesn't produce income, but it holds its value when everything else is falling. That's why gold is seen as a safe haven, a way to protect your wealth when times get rough. Each of these investments has its own purpose. There's no single best one that fits everyone. The right mix depends on who you are and what you're trying to achieve. That's why most investors don't choose just one. They combine them, some crypto for innovation, stocks for growth, real estate for stability, and gold for protection. That combination is called diversification, and it's one of the smartest ways to balance risk and reward. For most everyday investors, stocks or real estate are the most practical starting points. They're easier to understand, more stable, and have proven records over time. Cryptocurrency can be a small, high-risk part of your portfolio, while gold can act as your safety net when things get uncertain. If you learned something new today, consider liking this video and subscribing for more simple explanations about investing and finance. Thanks for watching, and see you soon.